Where do you think the price will go next, up or down? Of course it goes up because of this candle, which is called rejection candle. I will teach you in what situations you can effectively use rejection candles to have the highest probability. If you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, when a rejection candle forms on the chart, it shows rejection of higher or lower prices. The formation of this candle tells us that the market participants push the price in one direction, but finally those higher or lower prices were rejected. Rejection candles have short body, very small or no shadow on one side and a long shadow on the other side. The longer this shadow and the smaller the body, the stronger is the candle. Also, the color of the body is not important because the body is short and it shows a small movement of the price between open and close, but in case if the color matches the direction of the rejection, it would be better. For this candle with long upper shadow and small lower shadow, when it forms on the chart, it tells us that in that time period, at first the bulls or buyers were strong and they were able to push the price up considerably, but finally that's the bears or sellers who took the control and pushed the price back to lower levels where the candle was opened. This formation shows that the higher prices were rejected. There were no more interest to buy at those high prices, and instead selling interest increased, and so the price went down. This candle actually shows a shift in the balance of power between buyers and sellers, and it actually shows how the bears became the winner in that time period. Naturally, this candlestick is bearish and it shows the possibility for further decline of the price, but interpretation depends on the context, depends on where it forms, which I explain this later in this video. And for this rejection candle, which has a long lower shadow and small upper shadow, this is the opposite of the other candle. This formation shows that at first bears had control and they were able to push the price down considerably, but finally the buyers became the winner in that time period. Buyers could successfully take the control and push the price up, and the candle closed near the opening price. This candle shows that the lower prices were rejected. It shows that at those low prices there were no more interest for selling, and instead the buying interest increased, so the price went up near the opening price. This candle is naturally a bullish candle because it shows that in that time period the buyers had the upper hand, but the interpretation depends on the context, depends on where the candle forms on the chart. For example, this candle is bullish only if it forms near a support level, or this candle is bearish only if it forms near a resistance level. I'm going to show examples where we have rejection candles on support and resistance levels, trend lines, reversal of trends, on moving averages, and Fibonacci retracement levels. Before we start, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a comprehensive guide to price action analysis. The link is in the description and you can get it later if you want to completely learn price action trading. I also post educational contents on X, so make sure you follow me there and learn the tips and tricks about trading. Alright, as I said, rejection candles have meaning only in the context. A bullish rejection of the price is significant only if it forms near a support level, and similarly a bearish rejection of the price near a resistance level. On this chart you can see that we have a support level in this price zone. Here you can see that the price declined to the support zone and then rejected. We got a rejection candle here where the price at the support level got rejected, and you can see that the price advanced after that. Again here the price reached to the support zone and again rejected. This is a support level and we expect that the price will stop here and reverse. And when we have a rejection candle like this, it tells us that market participants showed reaction to this support level. Here, after a short advancing of the price, again the price turned down, but this time we have a much stronger setup. This time the price considerably went down below the support zone, swept all the liquidity and turned back and closed here. This rejection candle is stronger and more significant candle in compared to these two rejection candles. Why? Because here this is a sell side liquidity and we had a liquidity sweep here, which is usually done by institutional traders. This is a support level and traders opened long position here and here when the price was at this level, and they placed their stop losses below this level in these price ranges. They opened a long position, so the nature of their stop loss order is short position. So here we have lots of sell orders. That's why we say that we have a sell liquidity here, and institutional traders take advantage of this sell liquidity to fill their orders. And what we see on the chart is exactly like this, where the price goes down and hitting all the stop losses and instantly reverses back like this, creating a rejection candle. This rejection candle is highly significant. To make sure about the market sentiment, we can wait one more candle, and you can see that it's a strong green candle and totally engulfed the body of several candles before that. This is a strong and high probability signal that we have a major shift in supply and demand, and you just see what happened after that and how the price advanced to very high levels. When the price was closed above this resistance level, it confirmed a break out of this range market, and you can see we had a sharp advancing of the price. The next situation that we can use rejection candle is when they form near trend lines. As you know, trend lines are also support or resistance levels. An uptrend line acts as a support level and a downtrend line acts as a resistance level. But here, because the supply and demand are increasing at a pace, so lines are not horizontal and they are sloped up or down. On this chart, following the downtrend, you can see that we have a rejection candle near the trend line, and this is telling us that the higher prices are rejected, and being at the resistance level, this is considered a bearish candle. At this trend line, which acts as a resistance level, we expect that the price will stop here and decline, and now we have a bearish rejection candle. This tells us that the market participants reacted to this trend line, and after that you can see how the price declined. Again, the price goes for a pullback and we got another rejection candle at the trend line, as you can see, and this is a bearish signal, and after that the price went down as expected. Another situation where you can use a rejection candle is when you are using moving averages on your chart. This is actually a similar situation to trend lines. As you know, moving averages are a kind of dynamic trend line and they can act as support or resistance levels many of the times when the price is at or near the moving average line, especially moving averages with higher length, which are smoother and less responsive to short-term fluctuations. On this chart, we have a simple moving average with length of 100, and you can see that right now the price is at moving average and a bullish rejection candle is formed on the chart. Since the price is at the moving average line, we expect that the price will stop here and then reverses up, and now we have a rejection candle here, which is naturally a bullish candle. It shows that the lower prices were rejected, and it shows that the market participants are showing reaction to this moving average line, and after that you can see how the price advanced and continued the prior direction of the uptrend. Another situation where you can use a rejection candle is Fibonacci retracement levels. As you know, Fibonacci retracement levels can act as support and resistance levels, and they help us to know when the pullback is ended and the price is going to continue the prior trend of the market. On this chart, following the downtrend, you can see that the price went for a pullback, and we have Fibonacci retracement levels on the chart to identify when the pullback is possibly ended. In a well-established trend, usually 61.8% is the level where the price will stop and turn down. Here you can see that the price kept going up and reaching to 78.6%, and then suddenly we got rejection of those higher prices and the candle is closed at approximately 61.8%. Here, following the downtrend, these Fibonacci levels are acting as resistance level for this counter trend movement of the price. And now we got a rejection candle telling us that market participants rejected these higher prices. So probably the pullback ended, and after that you can see how the price turned down and we had decline of the price. Another situation where you can use rejection candles is when a reversal is happening in the market. For example, on this chart, following this uptrend, the price couldn't pass the previous high. Actually, the price went higher than this high, but then rejected, and we got a rejection candle here. When we have this rejection candle here in this situation, we know that the price will probably go down, but in terms of having a reversal of the trend, we need more confirmation. We cannot take a decision about reversal only based on this rejection candle, because after a short decline of the price, we can again have advancing of the price. So regarding the reversal of the trend, we need more confirmation. Right now, you can see that again the price stopped at this level and seems the price is not able to go above the previous high. We mark the last higher low on the chart, which is this level. This level is higher than this, but since the price didn't make higher high and we're actually in a trading range, we use this level and we wait for the price to break this level. When this level is broken, first, because it is the last higher low following the uptrend, it shows that the structure of the uptrend is already broken. And second, in this case, because we got a trading range here and this is the bottom of the range, when it is broken, it shows a new direction of the market. So when this level is broken, we can say with higher probability that a reversal is happening in the market. Please pay attention that trading is all about probabilities, not certainties. You can never have a trading setup with 100% probability. Even in the most perfect setup with many confirming signals, the market condition can suddenly change. So you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that can help you to minimize your risk and protect your trading account from falling significantly. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.